Thank you, first of all, for being here, Mr. Peck. And I just have a few simple questions for you. Hopefully they're simple. But as the Chief Investment Officer of Monroe Capital Corporation, can you give our listeners just a quick overview about your firm?
Sure. Monroe Capital Corporation is a publicly traded BDC. So it's structured as a registered investment company. So it's much like a closed-end fund. When people think about BDCs, they really equate them often to being a vehicle that's similar to a mortgage REIT. So a mortgage REIT would make mortgage loans, generate a return, and then pay a big dividend to its shareholders. Similarly, BDC is making corporate loans, commercial loans, and charging an interest rate and then paying a dividend to its shareholders. Now, Monroe Capital Corporation, our BDC, is part of a larger platform at Monroe Capital, where we manage approximately $2 billion for assets for all different sorts of investors, including institutional investors, as well as structured finance investors, and then our publicly traded company is Monroe Capital Corporation. We focus on lending money to companies that do somewhere between $3 million and $25 million of EBITDA, or free cash flow, and we do transactional lending. So it's usually, a privately owned company is looking to buy a competitor, perhaps take a small dividend. In some cases, it's a private equity sponsor that's buying a company, and we'll help finance them.
Great. Concerning your topic of discussion, business development companies for the income investors, what types of companies in which industries do you think should be in a portfolio for this target audience?
I think the most important thing is that you have a diversification of the industries you invest in. It's not necessarily that you want to focus on one industry or another. I think at the end of the day, the job of the manager of a business development company is to focus on making intelligent risk-return decisions. And so, not doing anything that's too far afield from your core business. Some business development companies focus more on mezzanine lending, which is subordinated lending. So you're typically in a mezzanine loan somewhere between 4 and 5.5 or 6 times EBITDA, and usually there's a bank lender in front of you who has a senior claim on the company. That's a little bit more risky investing, because if something bad happens and the company does poorly, you often don't control the workout situation because the bank that's in front of you is the one that controls it. We focus on senior secured first lien lending. In fact, approximately 90% of our portfolio is in senior secured first lien loans. And by focusing on that area, we can generate a stable and predictable dividend stream by investing in companies like that.
Fantastic. And as the Chief Investment Officer for Monroe Capital Corporation, tell us about your management philosophy. What distinguishes your approach to investing from the competition?
Sure. And some of what you're asking I just alluded to, which is a lot of the competitors in the BDC space will focus on mezzanine lending. But at the end of the day, what really distinguishes Monroe Capital is our focus on true proprietary origination. So Monroe Capital has offices, we're headquartered in Chicago, but we have offices here in New York, in Boston, in Charlotte, in Atlanta, in Dallas, in San Francisco, in Los Angeles. And we have people in those offices that are out in the field looking for proprietary, unique deals to originate that are different from what the competition is doing. Most of our competitors in the BDC space have a person sitting in an office somewhere between Fifth Avenue and Park Avenue with a bank of phones who are calling on private equity firms and asking for their next deal. And you can do a good job doing that. You can find good deals if you're good at analyzing credit. You hopefully won't have losses, but at the end of the day, that's very competitive. And the person that wins that deal is usually the loser, because they usually won because they had the lowest pricing or the weakest structures. We like financing sponsors. We do it all the time, but we like to balance that against true proprietary origination that has nothing to do with the private equity community.
Sure. And then with regards to income investors, why don't you tell us more about the constituency and their overall expectations?
Sure. So income investors should be focused on not only the dividend yield and the price per NAV of a company like ours, but also should be thinking a lot about how does a company generate a sustainable dividend yield. In the environment we're in now, a number of BDCs are seeing the average yield on their portfolio decline because it's very competitive in this environment. And it's getting harder and harder for BDCs to generate enough net investment income per share to support that dividend. And so what you're seeing in the market is a lot of our competitors are paying out a dividend in excess of their earnings. That's not a sustainable model. Every time you do that, you're basically diluting your book value because you're giving back capital. We're in a fortunate situation where we have been able to generate a portfolio in which the yield is increasing. And so because of that, you're seeing us cover our dividend by net investment income. And you have to be really careful here. There's some tricky language that people use when they talk about their net investment income and dividends. I heard one of the panelists today say that they covered their dividends through net investment income. And that maybe was true for the lifetime of their business, but if you look at what they did last quarter, they paid out a lot more dividend than they earned in net investment income. And so you really have to look at what's happening now. And right now we're in an enviable spot because we're actually supporting our dividend with real cash flow.
Great. And then why are business development companies an integral part of fulfilling the needs of income investors?
It's a great question. Income investors, tend to focus on just a few key areas. There's not that many equities out there in the market today, especially in this yield environment, that are providing real yield to investors. And so when you look around the universe of yield opportunities, you're focused on MLPs, many of which are taking serious commodity risk. You're focused on REITs, which are good businesses but tend to be really focused on one sort of real estate, whether it be commercial or equity, whatever type of REIT you're looking at. BDCs are sort of a unique little group of companies. It's not a very big market. And I think it provides great diversification to income investors who are really looking, to really the old school types of investments to generate yield. And I don't think you'll find an investment that's generating as high of a yield as consistently as the BDC market. So I think it's a nice part of a portfolio when you're looking at yield income investors.
Sure. And then what is your forecast for the sector for 2015?
Unfortunately, if we continue down the path we've been moving down, I think what you're going to see in the BDC sector is companies continuing to struggle to cover their dividend. And a number of our competitors who do just call on private equity sponsors and don't really have the true competitive origination that we have out in the field, really touching small companies on a one-to-one basis, I think they're going to struggle to maintain yields to support their dividend. So I think you're going to see the sector bifurcate as we go into 2015. You're going to see sort of the haves and the have-nots. You're going to see companies like ours who we think will be able to support our dividend with real income because we have so much great proprietary origination, and you're going to see some BDCs not. And it's not that I think that the whole sector is going to struggle. I think that there's going to be a number of really well-run, good BDC companies out there like ours that will do a great job finding great origination and putting assets on the books that will support their dividend. I think you'll find others that either fail to face reality and continue to overpay dividends and dilute book value, or will have to cut their dividend. And hopefully we don't think that our company will be one of those.
Great. I hope not either. And then also, what additional information would you like our listeners to know about Monroe Capital Corporation?
Great question. So it's important to note, when you look at Monroe Capital Corporation, it's not a very big stock. We have a market cap around $130 million. We have a $240 million portfolio. And if you look at that on the face of it, you'd think, how could they possibly really be out there with that many people originating assets in such a small asset base? And the reality is Monroe Capital Corporation is part of a much larger business. Monroe Capital has been around since 2004. We were Monroe Capital before the financial crisis. We're Monroe Capital during the financial crisis, and we're Monroe Capital after the financial crisis. It's the same people doing the same thing, and we do the same thing year in and year out. We make great loans to small companies. And because we're part of a larger franchise that has close to $2 billion in assets under management, that's why we can generate all this deal flow, a piece of every deal which will trickle into the BDC and provide an opportunity for retail investors that heretofore have really been only available to institutional investors and pensions and endowment funds. And that's why we really like this publicly traded BDC as a part of our overall business.
Great. Yeah, if it isn't broke, don't fix it.
That's right.
Keep it the same. One last question for you, just in regards to the Pristine Advisors Conference. What are your views on the conference, and how do you think that it could benefit not only advisors but investors as well?
Yeah, it's a good question. This is my first time presenting at this conference. I was really impressed with not only the attendance, but the quality of the questions that came from the people in the room. It was a really well-attended conference. I really like that they've branched out. Traditionally, when people think about closed-end funds, they don't really think about BDCs, but technically BDCs are a closed-end fund, and they're an important and growing part of the market. So I'm really grateful to Pristine for putting this together and inviting the BDCs to have a panel. I think it opens up to a universe of investors a new idea that many hadn't considered, and I think it's a great opportunity for us to go out and tell our story.
Fantastic. Well, we are grateful to have you, so hopefully we'll see you back here next year.
So nice meeting you.
Much.
Thank you.